Are you a UK property investor wondering whether to keep properties personally, in your personal name, or in a limited company? So, as we know, there was Section 24 introduced many years ago and is now in full swing. A lot of property investors these days are actually opting for a limited company structure. So, a lot of this actually depends on how much property do you want to invest in, what's your current tax banding, so are you a higher rate or a lower rate taxpayer, and what kind of properties do you actually want to invest in. If you're a low rate taxpayer, for example, and you only want one or two buy to let properties, then it may be best to keep the properties in your personal name, as the Section 24 tax relief won't really affect you. You'll also be able to get hold of cheaper interest rates. Or if you are a high rate taxpayer and you have big plans to make it in property, then a limited company is a great start. So what would happen is, in the limited company, you will be able to take off full mortgage interest, whereas you can't in your own name. Profits from the rental company will be taxed at 19 to 25%, which will be a lot lower than the 40 or 45% or even 60% tax rate that you may be paying as a higher or an additional rate taxpayer. And some of the cons are that a limited company, when they have mortgages, they are more expensive than if you were to have a mortgage in your personal name. But in a nutshell, if you're low rate and only want a couple of properties, keep it personal. If you are a high rate taxpayer and you want to make it big in property, then start with a limited company.